Please welcome to the stage Greg Bolino, Global Head of Sustainability, Strategy, and Asset Consulting at JLL, for a conversation with Bloomberg Green's Lauren Kiel.
Good morning, everyone. Greg, good to have you with me.
Thank you, Lauren. Pleasure to be here.
We're here to talk about value and returns. And we know companies are focusing so much more on sustainability. We're seeing that pressure that Gina was talking about earlier from the government side. We're seeing that customer and consumer pressure that the Daily Harvest team was talking about. But right before we jumped onto the stage, they were talking about how you have to make money out of this too, right? You got to make some money. So talk to us about that evolving case for sustainability, business side.
It's important. I mean, first, it's worth saying that there are real benefits to investing in sustainability in the traditional terms of real estate value, occupancy rates, rents, operating costs, and that's important. I think it's more important to kind of observe that value is migrating. The expectations in buildings, the performance parameters is causing a rethink of what buildings are worth. Now, right now, it's a little bit of a drift. So the drift could be upward if the building has some advantages. It could be downward if it's going to be a substantial investment or if it's complicated to put it on the right pathway. But if you think about that in the terms of, what do? You have to start looking at that drift now. Think also about the big outcomes of an investment in sustainability, carbon, resources like water and waste, human capital outcomes, productivity, efficiency, engagement. These are critical for companies trying to figure out the conundrum of not only return to work, but the future of work. Social value, obviously also important, and risk, important to all of us. So, if you think about a case on those outcomes made for what's it worth in the either protecting the value of the portfolio or improving the value, it's a sturdy case. In fact, it looks more like an imperative.
And I know you're talking to people across such a wide range, from investors to people who are actually occupying these spaces. I can only imagine the conversations that you're having with somebody in Texas in the US are very different than the ones you're having with somebody in Amsterdam or in Hong Kong. So tell us about that. How are those conversations evolving?
Well, I mean, there's always tensions, natural ones, between owners and investors. But I think what's really interesting is there's a bit of a shift as they start to look at their own goals. How will I achieve the goals I've set on both sides? And that kind of rethink is looking very simply like, well, what if I face a really costly upgrade? Do I want to make that? Or on the tenant side, if I look down all my leases, which ones of these buildings don't pass muster? So you could see a bunch of churn in the market, and we might. But more importantly, you could see a whole lot of collaborating start to become obvious, mutual investment between the investor and the owners. Now, green leases are already going on. There's a big trend toward green leases. Today, I think that's just a modicum of a start, because green leases today feel a lot like maybe negotiating checklists of terms. But the original intent, a decade or more ago, was that green leases would create incentives for co-investment. And I think we'll see much more innovative partnerships. And I don't know what they'll look like, whether it's contractual things or partner terms or equity investments. But the relationship between the investment and the owner and the occupier is critical, because they can de-risk each other's goals.
And one of the other things I'm sure you're working on with a lot of these people is helping them find a net zero pathway, which is, easier said than done sometimes. But what does that look like? Just kind of paint me a picture of what that pathway would look like.
Well, I mean, the key underlying challenge is data, which everyone knows. It's at the top of everyone's complaint, and it underpins all the thinking about the net zero carbon pathway. The key overarching, problem is that a lot of companies have set net zero carbon goals. In fact, 2/3 of companies report that they have, or more. Most of them admit that they don't have a clear path to achieving it. And look, it's understandable, like no judgment. It's hard, right? The data's not there. But it's going to force moving from what were traditionally incremental improvements in energy efficiency and cost, mostly operating performance, into more step change, improvements. So we partnered with the World Economic Forum late last year, published a checklist, 10 green building principles as to what it would look like or take to decarbonize buildings. And there's some obvious things on there, like more efficiency, more renewable energy, but it starts to illustrate much more importance around thinking infrastructure. And I mean energy infrastructure, energy assets like renewables, on-site and elsewhere, but also energy systems, fuel cells, thermal storage, geothermal systems, even batteries. Why? Because it will allow you to start to match the consumption and use that the building might need with renewable power that's available. Now, data center folks are already doing that, or they're investing, or they've announced and are on path to achieve what they call 24-hour matching. So as soon as companies realize that that expectation will be upon them, they'll start to look for that. And right now, the PPA market, purchasing power agreements for renewables, is already getting tight, because there's a lot of companies out there. So I think it's a key area to think about, and it's a challenge because these are new investments. The other one, I think, is transportation. People were surprised at how quickly the electrification of transportation came into the foreground. I wasn't terribly surprised. I also think we're underestimating the potential movement of the sector. So look at it this way. Either the official estimates are going to be right, and Ford Motor Company is going to have a terrible decade. They're spending $40-some-odd billion electrifying their automobiles. Or Ford is more right, and there's going to be a heck of a lot more vehicles on the road in a short amount of time. I think it's the latter. We have to at least be open to the possibility that our estimates are actually low. Then you look at buildings. You say, okay, I'm a company with 1,000 spots in the parking lot, and I've got 8 chargers. What would it look like to have 80? What would it look like to have 800? Now, let's stipulate that that's a future problem. Now let's look at a right now problem, which is if you're a logistically intensive company and you've got depots and distribution centers, and you've got sort of short haul trucks that are moving between distribution centers and pool centers, something like 60% of our trucking miles are those short haul routes. If you and I ran that company, we would know that tomorrow morning we could get 5, 10, 15, maybe as much as 20% cost savings annually by electrifying that fleet, because the short haul routes are easier to electrify. So then you say, well, then we just need to build infrastructure and we'll put it on the highway. No, these trucks turn around every 45 minutes. They have to be charged in the locations they're sitting. So then you go to your landlord and you say, I need infrastructure. So again, these are critical investments, and I think really heightening the need to invest in things. Interesting business models, interesting partner models. We're working with them, but people are going to have to consider all these things.
I bet if I asked people in this audience what they think of when they think of JLL, they'd say real estate or buildings, but you're increasingly thinking about yourselves and talking about yourselves as a technology company.
Yes, we are.
And why is that, and how does that tie to that pathway to net zero?
Well, we're investing huge in technology through JLLT, the company that is our tech platform company, and in our core business. I think it's worth saying that there's an arms race, or maybe even a feeding frenzy, for companies that have asset data or have platforms, and we see that. We also see all the prop tech that's exploding in that same neighborhood as evolving this constellation of platforms you might need. And I think it's important. We're going to stay in that, and we're in it big because it will be required. But I'll just give you 2 or 3 examples just by illustration. We built a platform called Carbon Pathfinder, which codified all of our best expertise about what it would look like to decarbonize a building. The fabric, the lighting, the ventilation, what would it cost, what would it return in terms of improvement, so that we could help create scenarios on what might be massive portfolios and start to think about what would the investment plan look like in real terms, not just in top-down guesswork terms. So that's a critical thing. We created something called Performa, which takes all of our transactive asset information about purchases and value and codified the value into understanding how that's going to be changing and how we could create econometric models that relate to ESG performance, or the performance around the sustainable outcomes I mentioned. These are critically important. We bought a company called Hank, which actually uses AI to, in real time, dynamically dispatch and manage the building management system so that they could operate. That's just the start of what's happening. I will tell you the arms race will continue, and it's a big deal, and it'll change quite a bit over the next few years.
Does regulation help you in this space? Are you looking for more regulation? I feel like we're starting to get there. There's appetite here in the US, there's long been in Europe. Is that helpful to you?
I think the important thing is to not get into a compliance mindset. I think it's easy to go into the wait and see, but the problem is the market forces I described before are moving a lot faster than the regulatory cycle. And so you think about smart investors are moving now, and we'll think about compliance along the route. Look at cities. I think it's really important, even as I say that, to understand the compliance landscape. Cities, there's 385 some odd cities that made carbon targets in the world. My hometown, Ann Arbor, Michigan, is literally standing up an electric utility in order for them to achieve their 820 goals, which is net zero carbon by 2028, one of the most ambitious in the country. And everyone's freaked out a bit about Rule 97 in New York, but there are 30 other cities that are actually collaborating to write model building codes that will be implemented in cities and counties around the country in the U.S. So that's going to be really important. And I think the SEC rule, obviously, is important and consequential. But again, the gestation on that is going to be a couple of years. I don't recommend waiting and seeing for that at all.
We have just a couple moments left. So tell me, what do you think the biggest challenge you're going to have to deal with is in decarbonizing real estate?
There's a bunch. I'll just say personally, talent. We are hiring like it's 1999. And if anybody remembers what the labor market back then was, or if you like Prince, there's a fervent push to get the talent that's needed. We've multiplied our investments in learning, development, talent acquisition, advisory. What's incredible about that is Prince wrote that song in 1984.
Thank you so much, Greg.
Thank you.
Thanks to JLL for this sponsor spotlight. We're going to take a quick break, so we'll see you all back here at 11:30.